Welcome back to Sunny Stocks India. Today we will try to value PPAP Automotive. If you are looking for a potentially undervalued small cap stock with re-rating potential, this company could be the one. They are into manufacturing of plastic and rubber based products for auto companies and are also into other related auto ancillary segments like injection molding. They got into lithium-ion batteries as well, and it is relatively new venture. Given that the automotive parts business contribute more than 90% to the revenue and the other businesses are still developing, we will focus on the health of this business while valuing the company. So PPAP currently trades at almost the book value and 6 to 7 times the earnings, whereas its close competitors like Unominda and others trade at a substantially higher valuation multiples because the market assigns a premium to their stronger growth, superior profitability, and better capital efficiency. If PPAP is such a laggard, then why are we even analyzing the business? That's because the most recent results and management guidance indicate that the business is at a positive turning point. If you look at the most recent year's results, you would notice that the business has made a profit of over 43 crores. But before we get excited, this profit is not coming from the core business. The business is still operating at less than 10% EBITDA. There was an exceptional item in their P&L. They sold their stake in their JV company PPAP Tokoe to their Japanese partner. They made an investment of around 50 crores about 12 years ago and exited the JV for a consideration of 100 crore. It wasn't a great ROI in the hindsight, but looking forward, this money can really help them reduce their debt, which will further reduce the interest cost, ultimately improving the return on capital employed, which currently stands at just 6.9%. While the management intends to use only part of the proceeds to reduce the debt and the rest they want to use it for product development and other growth opportunities, and for that they have entered into technology partnership agreement with Hutchinson. Hutchinson is a global company that reported over 5 billion euros in revenue in 2025. PPAP is very well placed to take advantage of this new partnership. With over 45 years of experience, 10 manufacturing facilities, and leading auto manufacturers as its clients, the business can deepen its relationship with these customers by offering world-class Hutchinson-backed products. Now, let's come to the valuation part. The company is valued at around 340 to 350 crores at today's price. Last year, the company did a revenue of 567 crores, and the company has set a target of 606 crores in revenue for the automotive segment. Please note, this does not include the revenue from Miraki Precision Tools, which is a wholly owned subsidiary for molds business, and it does not include revenue from their battery business, that is Avinya Battery, which has set a target of 120 crore in revenue. We will only use revenue from the dominant business for valuing the company, as other business contribute marginally to the profit. Avinya may surprise us with material contribution to the profit if they achieve the revenue target that they have set from the battery business. Anyways, as we want to keep the projections very conservative, let's say the core business, which is 90% of the revenue, achieves its target of 606 crores and they also achieve the margin of 21%. We are looking at an EBITDA of around 127 crores. From this, if we reduce the non-cash expense, that is depreciation, of around 33 crores, the business would be making around 94 crores in profit before interest, cost and taxes. Now let's assume the company pays off 25% of the 200 crore debt. That is, they pay off 50 crore from the 100 crore proceeds they got from the sale of their stake. This will reduce their finance cost from 17 crore to around 13 crore, and the company would make profit before tax of around 81 crores without any exception items. This will be real profit from operations. This will result in profit after tax of around 60 crores, and given the better performance, if the market re-rates the business and gives it a PE of just 12, similar to the PE offered to the competitors, then the market cap would increase from the current around 340 crores to around 730 crores, which means the stock has the potential to more than double from the current 240 to over 500 in the next 12 months. This was my analysis of PPAP. Keep tracking the quarterly results and make sure the business stays on track, and do your own research. Thank you and bye bye.